we're seeing a very strong fundamental position for the US consumer. It's been forced into an excess savings position, and effectively the savings rate across the income stream, low income all the way through high, is relatively high compared to normal. And as a result, with the lockdowns of last year and a freer situation this time around, we're seeing more of the in-store, as well as also, of course, very strong e-commerce spending. Interestingly, when you look at the breakdowns of how we expect the spending to go, it's not just the categories of reopening up, of getting out and about, that are likely to do better. Of course, it is the usual gifts, but apparel, for example, that didn't do so well during the peak of the pandemic, that is making a comeback. Same sort of thing that we're seeing with the strength of electronics that's already been quite strong. And interestingly, in all these new categories that are doing better as we open up, say in beauty products, it's not yet, in our view, at the expense of the ones that had already been doing well during the pandemic, like, say, groceries or home improvement.
Okay. We're expecting then this 10% growth that you mentioned, even better on what we saw in 2019. But this all comes at an environment, or in an environment where we, of course, have rising prices, inflation trading at tracking at the highest level that we've seen in decades. That's not discouraging consumers, that they're going to have to pay more for things than they did, even only a year or two ago.
Well, it comes from the original reason for the inflation, that it absolutely, to your point, you're right, it is partially to do with supply bottlenecks and constraints. And that's a challenge that we'll be facing through the rest of this year and all the way probably through the first half of next year. But it's also happening because of the strength of demand. And we may see that strength of demand, as I said earlier, with the strength of or high levels of savings, that could transfer a little bit more into experiences and more into services next year, rather than just being all about goods, as it has been more so this time around. But the key point here is that we have high prices because of the strong demand. So that demand-led inflation, of course, made worse by the bottlenecks, could mean a few things. Firstly, of course, we are seeing a bit less discounting, most likely from stores. They don't need to cut prices as much to get the sales and get consumers in the door, though there will be some. But also, we could be seeing a shift towards, if people are worried about getting hold of goods, they may even show some interest in, say, going ahead with gift cards if they're worried about the extra surcharges for delivery or for the potential wait that could be beyond the holiday period before they get the goods they're looking for.